Have you ever found yourself wondering how these huge companies, the ones often working behind the scenes, actually manage things? How they navigate all the shifts in industry and economic uncertainty?
Yeah, it's a good question,
Yeah,
especially beyond the big headlines. What's really driving their success?
exactly. Particularly for something as basic, as fundamental as getting food to restaurants.
The real story is often buried in the operational details, the strategic tweaks that don't always make the news.
And that's precisely our mission today. We're doing a deep dive into Sysco. They're the global leader in food service distribution. If you've eaten out, well, chances are Cisco played a role.
A pretty significant role, yeah.
So we're going to unpack their latest results. That's the fourth quarter of fiscal year 2025, and also look at their guidance for fiscal year 2026.
And we're drawing directly from their earnings call and their news release, both from July 29th, 2025.
Great. We want to cut through the corporate jargon and really understand their operations, the market dynamics, their future plans.
And what it all might signal for the wider food service industry. It's fascinating because they seem to be positioning for growth even when the overall market is, well, a bit challenged.
It really speaks to internal execution, doesn't it?
Absolute strategy and just getting things done.
Okay, so let's get into the big picture first. Q4 FY25. The headline was that their adjusted results exceeded expectations.
Yeah, that's the main takeaway. And they put it down to two things: their own specific initiatives, Cisco-led efforts, and also, importantly, better traffic in the restaurant industry overall.
That improvement in foot traffic feels pretty significant.
It really is. After some tougher quarters, things seem to be stabilizing a bit. Q3 traffic was down 3%, but Q4 improved quite a bit, only down 1.1% nationally.
And there was a trend within the quarter, too?
Yeah, you could see it accelerating. April was down 1.5%, May improved to down 1%, and June was even better, down about 0.9%.
So getting progressively less negative.
Exactly. And they said this momentum continued into July. They called it strong exit velocity heading into the new fiscal year.
Exit velocity, I like that. It sounds like they're carrying real momentum.
It suggests it's more than just hoping for things to get better. They're seeing tangible improvement.
Okay, let's hit the key numbers for Q4, comparing this year to last year. Sales first.
Sales were up 2.8%, hitting $21.1 billion.
Which is already huge, but wasn't there a divestiture that complicates that slightly?
Right. They sold their Mexican business. If you exclude that, sales were actually up 3.7%, a bit stronger.
Okay. And what about profit, adjusted operating income?
That was up 1.1% to $1.1 billion. So core operational profit moving in the right direction.
And adjusted EPS, earnings per share.
That showed stronger growth, up 6.5% to $1.48 per share. That's where you see the profitability really flowing through.
What about gross profit and margins?
Gross profit increased 3.9% to $4.0 billion. And significantly, their gross margin expanded by 19 basis points.
19 basis points, so nearly 0.2 percentage points better margin.
Yeah, up to 18.9% overall. And that's despite some inflation, about 3.5%, they said, mainly in meat and dairy. So they're managing costs and pricing effectively.
And adjusted EBITDA, that gives a clearer operational cash flow picture, right?
Right, before interest, taxes, depreciation, amortization. That was also up 1.8% to $1.3 billion. It all points towards good progress on that $100 million profit improvement goal they set.
Strategic sourcing seems to be helping there.
Definitely made a strong contribution in Q4, they highlighted.
So a solid end to the fiscal year. Just for context, the full year FY25 numbers.
Full year sales were up 3.2% to $81.4 billion, and adjusted EPS grew 3.5% to $4.46.
And they're sending some of that success back to shareholders, too.
Oh, yeah. They returned about $2.3 billion in FY25. That was roughly $1.3 billion in share buybacks and $1 billion in dividends.
That commitment to dividends, their dividend aristocrat status, that signals confidence, doesn't it?
It absolutely does. It tells investors they expect consistent, sustainable profitability and strong cash flow, even when things are, a bit tough out there.
Okay, let's zoom in a bit. Cisco's a global company. How did the different segments perform? International sounds like a real highlight.
It really was. They called it another compelling quarter. Top-line growth was 3.6%, as reported.
But again, the Mexico divestiture.
Right. Excluding that, growth was an even stronger 8.3% internationally. And local case volume, basically, the amount of stuff they sold, was up a solid 4%.
4% case growth internationally is pretty impressive in the current climate.
It is. And the profit growth was even more striking, Adjusted operating income up 20.1%.
Wow, 20%.
And get this, it was their seventh straight quarter of double-digit profit growth internationally.
7 quarters. That's not just a blip, that's sustained performance.
Exactly. And it wasn't just one place. They mentioned strong results in Canada, Great Britain, Ireland, Latin America. Pretty broad-based.
So what's the plan to keep that going in FY26?
They expect it to continue. They're pushing forward with those Sysco Your Way selling initiatives, making things easier for customers. Plus, improving tech for both customers and their own staff.
Makes sense.
And they're adding more local sales resources in key cities like Toronto, Dublin, London. And expanding capacity, a new facility near London should open later this calendar year.
So investing in growth where it's working well, the big question is, can they replicate that success everywhere?
That's always the challenge with global operations, translating what works in one market to another.
Okay, let's pivot to the U.S. food service segment, USFS. That's their biggest piece, right? Sounds like the picture there is a bit more nuanced.
It is. Still encouraging signs, but more complex. Local case volume in USFS was actually negative 1.5% for the quarter.
Negative 1.5. But that sounds like a step back.
Well, context is key here. It was actually a big improvement from Q3, a 200 basis point step up, they said.
Yeah.
So significantly less negative than before.
Ah, okay. Improvement, even if still slightly down.
And there's another important piece. They intentionally exited some less profitable business within their FreshPoint produce unit.
Ah, so they deliberately cut some volume.
Exactly. Because it wasn't meeting their profit goals. That decision alone negatively impacted their total local volume by over 50 basis points, so more than 0.5%.
Okay, so if you adjust for that intentional exit,
Then their underlying local business was only down about 1%, which again is a marked improvement from Q3.
got it. So progress driven by their own actions too. They said that momentum carried into July.
Yes, driven by those Cisco-specific initiatives,
Yeah.
it shows they feel they have levers they can pull regardless of the broader market.
What about the national sales part of USFS that serves the big chains, right?
Correct, and that part performed at a very high level. Volume there was actually up 1.3%.
Positive volume growth there. Which sectors were strong?
Especially non-commercial areas. Think food service management companies, education, travel and leisure. Those were robust.
And the profitability of that national business.
This was crucial. Gross profit in national sales grew almost 3 times faster than the volume did.
3 times faster? How?
Through what they called customer optimization and creating win-win provisions in contracts. Basically finding ways to be more efficient that also benefit the customer, encouraging them to partner more deeply.
Smart. Aligning incentives.
Exactly. And for FY26, they expect growth in national sales to keep coming from those strong segments: food service management, travel, leisure, healthcare, supported by targeted investments.
Sounds like a well-thought-out approach. Before we dive into their future plans, any word on the SYGMA segment? That's the custom distribution for chains, right?
Yeah, SYGMA had a fantastic year overall. Q4 sales were up 5.9%. For the full year, they hit record top-line growth of 8.3% and bottom-line growth of 12.5%. Really strong.
But they expect that to slow down a bit.
Yes, they expect growth rates there to moderate in FY26. It's mostly because they're now comparing against a period where they had some really big customer wins in FY25. So the comparisons just get tougher. It's pretty normal.
Okay, that makes sense. So looking ahead to fiscal year 2026, how are they planning to build on this Q4 momentum and maybe turn any remaining challenges into advantages?
They sound very confident, actually. They expressed very strong confidence in delivering profitable local volume growth in FY26, especially in the U.S.
And they feel they've tackled the main issues from FY25.
Yeah, they explicitly said they've addressed the key challenges head on, which is a pretty bold statement.
So what were those key challenges and how are they tackling them? It sounds like sales team stability is central.
Absolutely. That's a core driver. They said sales colleague retention fully stabilized in Q4. That's huge.
Why is that stabilization so important?
Because it lets them shift focus from just hiring and replacing people to actually training, improving productivity, making the existing team more effective.
Less churn, more focus.
Exactly. And that stability directly leads to significantly improved customer retention. What was a major headwind in 2025, all that turnover and the customers lost because of it should become a tailwind in 2026.
A tailwind. That's a powerful shift. Is there a learning curve for new sales staff?
Yes, they mentioned new sales consultants really start hitting their stride, becoming more productive between month 13 to 18 on the job.
So about a year to 18 months in.
Right. And now, because retention is better, they have an increasing number of people hitting that critical productivity milestone.
Yeah.
It creates a positive cycle.
More experienced reps, better results.
And they shared a really telling data point. The gap between new customers they won and customers they lost doubled in Q4 compared to the first 3 quarters of the year.
Doubled. So they're adding net new business at a much faster rate now.
Precisely. And they expect that positive gap, that spread, to widen even further in FY26. That really underpins their confidence in volume growth.
Okay, so stabilizing the sales force is step one. What about new initiatives? They mentioned 3 growth activation initiatives launching soon.
Yes, rolling out this summer and fall. First is Perks 2.0. Sounds like an update to their loyalty program.
It's more than just an update, it seems. They're evolving it from mainly marketing and rewards into what they called a hard-hitting, exceptional customer service program, really focused on their most important customers, the ones who buy the most often.
So, using loyalty as a lever for better service delivery.
Exactly. They said operations, inventory, merchandising, sales, everyone's trained on it. The goal is better retention and deeper penetration, getting those key customers to buy more categories from them.
And it's a nationwide rollout this summer. They must be pretty confident.
Seems like it. Okay, initiative number 2. An AI-empowered sales tool. Sounds very high-tech.
Yeah, AI 360 CRM.
Yeah.
Your tech teams have basically supercharged their existing CRM system with AI right on the sales reps' smartphones.
Supercharged CRM. What does that actually do for the rep?
The goal is to boost selling effectiveness, increase the success rate when they suggest products, and ultimately improve customer satisfaction.
Makes sense, like having a smart assistant.
Right. And they think it'll be especially helpful for newer reps, helping them get up to speed faster. It's rolling out now in piloted areas across the country.
Interesting. Okay, the third initiative, price agility. Pricing is always tricky territory.
Very delicate, yeah. They're piloting changes to their pricing system to give sales reps more power to make in-the-moment pricing decisions using software tools.
But the goal isn't just to cut prices, right?
No, they were very clear. The aim is to improve volume, but to do so profitably, not to sacrifice margin rates.
So how do they ensure that?
It requires a lot of change management. They need to train reps on new skills like how to sell around the room, meaning if you give a bid on price for one item, you need to sell other higher margin items to make up for it.
So it's about smarter, more flexible selling, not just discounting.
Exactly.
Yeah.
The pilot expanded in July, but they stressed it's not a primary growth driver for FY26 yet. They'll roll it out slowly at the pace reps develop these new skills. They want to avoid rushing it and hurting margins.
Smart. Okay, so with all that context, the Q4 performance, the stabilized sales force, these new initiatives, what does it all translate to in their financial guidance for fiscal year 2026?
Let's start with the top line. They expect net sales to grow approximately 3 to 5%. That puts them in the range of $84 billion to $85 billion for the year.
Okay, 3 to 5% growth. What's baked into that assumption?
It includes about 2% inflation, similar to what they're seeing now, maybe 2.4% in the U.S., 3.4% internationally, and then the other 2 to 3% comes from volume growth and any potential M&A activity.
Got it. Now what about the bottom line? Adjusted EPS growth.
Their guidance is for 1 to 3% growth, targeting $4.50 to $4.60 per share.
1 to 3%. That sounds a bit low compared to the sales growth and the confidence they expressed. Is there something else going on there?
Yes, absolutely. There's a key piece of context. That 1-3% includes a significant headwind, about $100 million, or 0.01 cents per share, just from lapping lower incentive compensation from FY25.
Ah, so basically bonus payouts were lower last year, which makes this year's growth look lower by comparison, even if the underlying business is strong.
Exactly. If you exclude that specific one-off impact, the underlying adjusted EPS growth outlook is actually about 5 to 7%.
Go 5 to 7%. That feels much more aligned with their long-term goals.
Right. The midpoint of that 5-7% range lines up pretty well with what they call their long-term growth algorithm. It shows the underlying operational engine is performing as expected.
And they're staying committed to shareholder returns in FY26?
Very much so. They plan to return about $1 billion in dividends and another $1 billion through share repurchases.
And the dividend itself.
The expected payout represents about a 6% year-over-year increase per share, really reinforcing that dividend aristocrat commitment.
What about their balance sheet, debt levels?
They ended FY25 with a net debt leverage ratio of 2.85 times. Their plan is to get back into their target range of 2.5 to 2.75 times by the end of FY26.
So managing debt carefully while still investing.
Yeah, they stressed maintaining an investment-grade balance sheet. They have plenty of flexibility, about $3.8 billion in total liquidity.
Are they still investing heavily in operations too? New buildings and such?
Oh, yes. They expect higher depreciation and amortization costs, specifically because they're continuing to expand capacity.
Yeah.
They mentioned 10 new buildings going live globally this year.
10 new facilities. Where are some of those?
7 are in the U.S., places like Allentown, Tampa, East Wisconsin, L.A., Las Vegas. Significant investment. Overall CapEx, capital expenditure, is expected to be around $700 million.
That's a lot of building. What does their overall guidance assume about the industry environment? Are they banking on a big restaurant recovery?
Actually, no. Their guidance assumes that industry foot traffic and the general macro environment will be similar to current conditions.
Which means still slightly down.
Basically, yeah.
Yeah.
So their planned growth isn't relying on the whole market lifting up. It explicitly assumes they will achieve growth by taking share from competitors.
That puts a lot of pressure on their internal execution, those initiatives we talked about.
It certainly does. They're betting on themselves to outperform the market.
One last check. Are they seeing signs of stress among restaurants, like closures impacting their business?
They address that directly. Said bad debt as a percentage of sales is very low, less than 0.1%. And crucially, they're not seeing specific pain in the local mom-and-pop restaurant sector to be higher than large customers.
That's actually quite reassuring about the state of the independent restaurant sector, at least from their perspective.
It suggests their diverse customer base and maybe their focus on providing value helps buffer them and their customers from some of the worst pressures.
Okay, so wrapping this all up, Sysco seems pleased with Q4. They've got that strong exit velocity carrying into the new fiscal year.
Yeah, and they're really banking on that improved sales force retention and tenure, plus the new growth programs, Perks 2.0, the AI tool, price agility to drive profitable case growth and hit those FY26 targets.
They're leaning into their competitive advantages too, being diversified, having a huge product range, and being the only truly global player.
Right, that scale and scope is a massive advantage in this industry.
And fundamentally, they believe the whole food away from home market is solid, that it keeps taking share from grocery stores every year.
And they just want a bigger slice of that growing pie. Makes sense.
This whole deep dive really highlights how a company can target growth, profitable growth, even when the overall market isn't exactly booming. It's not just about waiting for better times.
It really underscores the power of focused internal execution, strategic investments like AI and customer loyalty, getting your own house in order, essentially.
So here's a thought to leave you with. What does Cisco's approach tell us about shaping your own destiny in a tough market? How much control do organizations or even individuals really have through smart strategy and relentless execution, even when external factors aren't ideal? How could those principles apply in your own field?
Something to definitely think about. It's about focusing on what you can control.
Indeed. Lots to mull over until our next deep dive.